Welcome back to Fundamentals of Accountancy, Business, and Management. In this video, we're going to be talking about types of major accounts. Content standards. The learners demonstrate an understanding of the 5 major accounts, namely assets, liabilities, capital, income, and expenses. Performance standards. The learner shall be able to define, identify, and classify accounts according to the 5 major types. Learning competencies. The learner shall be able to discuss the 5 major accounts, cite examples of each type of account, prepare a chart of accounts. Remember that in the previous video, we talked about the accounting equation, and the accounting equation is assets is equal to liabilities plus owner's equity. And for every transaction, the accounting equation should always be balanced. Assets are what we refer to as resources owned by the business. Liabilities are debts or obligations by the business. And equity is the residual interest of the owner of the business. Now, in the previous video, we also talked about the 4 elements that affect equity. That would be investment, it increases the equity. Withdrawal, it decreases the equity. Revenue increases the equity, and expenses decreases the equity. So, our accounting equation is assets is equal to liabilities plus owner's equity. Now these are the types of major accounts. We have the assets, liabilities, equity or owner's equity, income, and expenses. And the definitions are given here. The assets are resources owned and controlled by the firm. Liabilities are obligations of the firm arising from past events which are to be settled in the future. Equity or owner's equity are the owner's claims in the business. It is the residual interest in the assets of the enterprise after deducting all its liabilities. Income refers to the increase in economic benefits during the accounting period in the form of inflows of cash or other assets, or decreases of liabilities that result in increase in equity. And expenses refer to decreases in economic benefits during the accounting period in the form of outflows of assets or incidences of liabilities that result in decreases in equity. Let's start talking about the assets. Remember that assets are the resources owned by the firm. There are what we current assets and non-current assets. Current assets are those that can be realized. When you say it can be realized, that means collected, sold, or used up within 1 year or after year-end date. Examples of current assets are cash, accounts receivable, merchandise inventory, and prepaid expense, to name some. Now, non-current assets are assets that cannot be realized 1 year after year-end date. Examples are property, plant and equipment, like furniture, building, land equipment, and also long-term investments. We can also classify assets as tangible or intangible. Tangible assets are physical assets such as cash, supplies, and furniture and fixtures. Tangible means you can touch, you can see. And intangible assets are the non-physical assets. Say, for example, you have patents and trademarks. There are several account titles that we use for asset accounts, and we're going to be naming some of the common ones. The first one is cash. Cash is money on hand or in banks and other items considered as medium of exchange in business transactions. So for the most common would be the account title cash on hand, and cash on hand would be that cash that we have in the company or in the possession of the people in the company. But when you say cash in bank, these are the ones that the business or the company deposits in banks or financial institutions, so we can recognize them simply as cash in bank. Next would be accounts receivables. Accounts receivables are amounts due from customers arising from credit sales or credit services. We recognize accounts receivable when we give the service or provide the products, but the customer don't pay us. So that means there's an amount that we can collect from the customer in the future, and that is the accounts receivable. Say, for example, you are doing repair services and you already repaired an item of a customer, but the customer didn't pay or just intend to pay after a few days, then you're going to have an accounts receivable. Or probably if you have delivered the items that the customer ordered, but they are going to pay, let's say, after a month, then you also have accounts receivables. The next one is notes receivables. These are amounts due from clients supported by promissory notes. Now, the difference between an accounts receivables and the notes receivables would be the promissory note. If there's a promissory note, then you recognize it as notes receivable. Otherwise, it is an accounts receivable. Next would be inventories. These are assets held for resale. This is more common for merchandising businesses. The things that the business purchase so that they could resell them are recognized as inventories. Next would be supplies. Supplies are items purchased by an enterprise which are unused as of the reporting date. Supplies could be office supplies, laboratory supplies, or whatever account the business uses. Prepaid expenses. These are expenses paid in advance. They are assets at the time of payment and become expenses through the passage of time. One example is a prepaid rent expense. If today is January 1st and the business paid for the rent of the company for the entire year, for the next 12 months, then there is prepaid rent expense. And every month, the business can recognize a rent expense and the prepaid rent expense will be reduced. Next is accrued income. Accrued income is revenue earned but not yet collected. It could be in the form of interest income that come from notes receivable from the promissory notes that the customers issue. And then you have short-term investments, which are investments made by the company that are intended to be sold immediately. Next would be the non-current assets. So the first one is the property, plant, and equipment. These are long-lived assets which have been acquired for use in operations. And I believe the account name explains it all. That's property, plant, and equipment. This can also be separated into several accounts. You can have exploration equipment, you can have laboratory equipment, or any other equipment account that the business uses. Long-term investments are the investments made by the company for long-term purposes. In comparison with the short-term investments in the current assets, the long-term investments are meant to be held by the company for a term longer than 1 year. Next would be intangible assets. These are assets without a physical substance, just like what was mentioned earlier. It could be patents, trademarks, and also franchise and copyright. Now let's move on to liabilities. Liabilities are obligations of the firm arising from past events which are to be settled in the future. Let's compare current liabilities and non-current liabilities. Current liabilities are liabilities that fall due within 1 year after year-end date. So when we say fall due, that means liabilities that are paid or recognized as revenue within 1 year after year-end date. Examples of this are accounts payables for that matter, accounts payable, utilities payable, and unearned income. Now, non-current liabilities are liabilities that do not fall due within 1 year after year-end date. So these are liabilities that are meant to be paid after 1 year or for more than 1 year. Examples include notes payable for more than a year with terms of more than 1 year. We have loans payable and also mortgage payable. Now let's go over some account titles that we use under current liabilities. The first one and the most common is the accounts payable. Accounts payables are amounts due or payable to suppliers for goods purchased on account or for services received on account. If we bought something from a supplier but we didn't pay in cash, then we have accounts payable. Or if we receive service from another entity but we didn't pay or we haven't paid for that service yet, then we have accounts payable. Next is notes payable. These are amounts due to third parties supported by promissory notes. This is in contrast with the accounts payable. The only difference is the presence or the existence of the promissory note. Next is accrued expenses. These are expenses that are incurred but not yet paid. Examples are salaries payable, taxes payable, and more. If we recognize salaries expense today, but we haven't given the salary to the workers yet, then we have salaries payable. Or if we already recognize tax expense today, but we're meaning to pay the taxes after a month, then we have taxes payable. Next is unearned income. Unearned income is cash collected in advance. The liability is the service to be performed or goods to be delivered in the future. Say, for example, a customer would like to get tutorial services and the customer already paid for the tutorial service, but the business hasn't given the service yet, then there is unearned income to be recognized. And that falls under the current liabilities. Now for non-current liabilities, loans payable. These are loans payable which terms is for more than 1 year. Mortgage payable is the same. Mortgage payable is usually has terms longer than 1 year. So we consider them under the non-current liabilities. The next type of major account is owner's equity. Owner's equity, again, is the residual interest of the owner from the business. It can be derived by deducting liabilities from assets based on the accounting equation that we studied in the previous video. Now, there are several equity accounts. The first one is capital. Capital is the value of cash and other assets invested in the business by the owner of the business. When we recognize a capital or an investment, we usually use the name of the person who invested and then capital. Say, for example, it is Jasmine Batawang who invested money to the business, then we can make the equity account as Jasmine Batawang Capital. Next would be drawing. It is an account debited for assets withdrawn by the owner for personal use from the business. In contrast with the capital, if the owner invested in the business, then we recognize owner and then capital or owner's capital. But if the owner got some assets or anything else from the business for personal use, then it is recognized as drawing. If the investment, for earlier example, if Jasmine Batawang invested something in the business, let's say cash, then we recognize her equity in the business as Jasmine Batawang Capital. And then if she withdraws let's say cash from the business for personal use, then we can recognize an account under Jasmine Batawang drawing or Jasmine Batawang withdrawal. Next would be income. Income is the increase in resources resulting from performance of service or selling of goods. If it is a service business, then we can record it as service revenue. And for merchandising and manufacturing businesses, we record the income as sales or sales revenue. Expenses. These are the decrease in resources resulting from the operations of business. We have different expense accounts, and some of them include salaries expense. The money that we pay to our workers as their salary would be recorded under salaries expense. Interest expense, it could be the amount of money that we pay for on top of our loans or on top of the notes payable that we issued. Another example is utilities expense. It could be the expense on the internet connectivity or telecommunication, or probably water utility, and electricity. There are other expense accounts, and you'll be learning more of them as we go along with the topic. Now I'll be introducing chart of accounts. A chart of accounts is a listing of the accounts used by companies in their financial records. It also helps to identify where the money is coming from and where it is going. Also, the chart of account is the foundation of the financial statements. So before we make a financial statement, it is necessary for us to have the chart of accounts. What are the steps in the preparation of a basic chart of accounts? The first one is you have to create 2 columns. Then you have to prepare or list down your assets altogether, from the current assets to the non-current assets, and then you also have to list down your liabilities, from the current liabilities to the non-current liabilities, and also your equity accounts, then revenue accounts and expense accounts. Once all of them is ready, then you have to list them down in the first column. So the first column would look like this. So if you have your asset accounts, you have the cash, accounts receivable, inventory, and the rest. We start it with the most liquid, and that is cash. Now, step 4, on the second column, you choose an account code. This is based on the discretion of the company. So you can number it as 100 or 001 and then 002 or 1000, 1200, just like in the example. It depends on the discretion of the company. And on the third column, you write the description for each account on when to use it. So in this example, let's say we use office rent and utilities to record office rent, insurance, and utilities expenses. Or probably for consultant fees, we use this account title to record expenses on the guest speakers and external trainers. So we're going to write the description for each account on the third column. More of this will be discussed in the next video.